Hello guys, now we have come to the time of adjustment of the Call Condor.
Want to meet like minded traders and discuss option strategies, adjustments, and more? Just type in Discuss Nifty in your Telegram search box and join the friendly trader community.
So we are going to move the 15200 and 15300 position. We are going to move close to the spot. Here you can see we are having a handsome profit of about 6,000, 5,000 to 6,000 rupees. So what we will do, we will move because the index has moved 200 points from the time of entry. You remember we entered at 15,430. So now it is 15,630. So the index has moved 200 points. So now you can see that we are having about 4.5 K loss in the bear call spread. We are not going to touch that because the standard adjustment is move the untested side close to the spot. So what we will do, we will be moving the 15,200, 300 to 200 points close to the spot. So then the new strikes will be 15,400 and 15,500. So let us see where the 15,400, 500 is there. So we will do 15,400 CE. So we just add it here and 15,500 CE for the June 3rd expiry. So here we are getting about 20 points. Okay, here we don't see the points. Basically, like we are doing adjustments. So we are already booking a profit on the points. Here you see we are hardly, it's 5 points. So we have captured almost 20 points here because our difference when we took the spread was about 25 points, if you remember in our previous video. So now is hardly anything. So we have captured a lot of points here. We are losing here, that's okay, but we have captured a lot of points here. So we will do the movement now. So it is about 237. It's coming down, so market is just moving. So 238, 157, 158. So it's about 18 to 20 points. So it's good. So first what we do, we need to close the existing spread. So I'll be closing the existing spread. Let us see what premiums we are getting. So we are getting 420, 421, 1 rupee less. Here we are getting about 1 rupee. We can close it by market, should not be a problem. We will have a slippage of 1 to 2 points, but that's okay. Means we can have that slippage because if you put a limit order, maybe like you may have to wait, it may not get executed so fast, so we may have to wait. So the spread difference is about 6.5 to 6 points. So I think we can close it with market. So when we close, probably like we might lose 1 or 2 points on the spread. So if we lose like 2 points, it is okay. Otherwise you have to put the market order and wait for it. So the market order waiting is not that great because the sometimes it may not get executed, the market may reverse, and then you will be waiting. So better to close it with the market order. You see here it is reducing, but there is no trade is happening. So it has come to 415, 440. Yeah, now it's changing. So now we have about 7 points, not 7. Here you can see the price is still there, so it's not an issue. So yeah, we will close it with the market. So we exit these two positions on a market order. So 15,200 and 15,300. So it's a reverse position. Basically 15,200 we are going to sell to close, and 15,300 we are going to buy to close. Exit. So done. So both the orders are already done. So the spread what we got is not good. You see it's a huge slippage we got. So this is quite normal in doing the ITM options. So let us take here, we don't go for the basket order. So what we do, we are going to buy 15,400, we are going to sell 15,500. So first let us execute the buy leg. So buy, so we will do 300 and 238. So we will do, okay, market, we can do market. Let's see, 239, not much. So 239, 240. When you're buying, we'll be buying at the offer price. So 239, 237. So let us do the buy. So buy is done, and we are going to sell 15,500. So 300 quantity. What's the price? 155. So we'll be buying it. We'll be selling it at the bid price. So bid price is about 155, 157. You see it's moving up. So let's execute it here. So 156.4. So we got it at about 236, and we paid 236, we got about 156, so the difference is like almost 20 points. So this is good. So we have booked some profit here. Let's update our Excel file. You see, this is what the adjustment is, but here the adjustment is not quite good because we have lost, the slippage is a bit high. Means you can see the slippage is about 8 points. So eight points is 8 points. So it's quite high. It means huge slippage we got here. This is not good. We should have done limit order, but we have done market order here. Let's update our Excel file. So what we booked, we will have the actual profit may not reflect it, but we will do it manually, that one. So what we did, we closed here. So 15,200. Let's go to the orders. So 15,200, we got 1, 2, 416.99, 417, 417. So here we got back, we means about 42,000, and 300 we bought back. So this is 360, 24.35. So we put back here. So we have booked about 5,000 rupees of profit. Now we have taken a new position. This position is still open. The bear call is still open. Only on the bull call we booked profit. So we did 15,400 and 15,500. So we did 15,400 buy and 15,500 sell. Let's copy the premiums from here. We have done that. So buy and sell. We'll put it back here. So this is 300 quantity and 300 quantity. So 15,400. 15,400 we bought for 236.63. And 15,500 we sold for 156.48. You will see that we have paid out 24,000. So the actual profit may not reflect the correct one. You can just see the booked profit, because the actual profit, what it does, it takes the premium paid, because the adjustments, when we close this one, the whatever the premium paid, we will be recovering something back. So that is not reflecting here, but that's quite all right. Right now we have booked somewhere around 40%, means we have moved up and we have booked about 40%. Let's see, means how it goes. So this is how we make the adjustment. So here, how many points we lost? You can say 324 plus 108, 100, and yeah, we got about 8 points here. Means yeah, 416 like plus 8 is 424. So the difference is minus 100. So I think we lost about 7-8 points. So 7, we were having about 6 point of difference, but due to the execution at market price, the slippage is about 1 point each, so 2 points. That's quite all right. It is bad, but it's quite all right. Means we have booked a handsome profit. If that 1 or 2 points, if we received, the profit would have been in the range of 5,600 rupees, because every point is 300 rupees here. So because we have a 300 quantity, 4 lot quantity. So every point is 1 rupee. So 300 plus 300, about 600 rupees is the slippage, but that's quite all right. 600 rupees here is about 10% of the profit booked. So when you do the ITM options adjustments, you need to be careful. I was careless, so don't make this mistake. That's it for now. Let us see means how the market moves. So right now, I think the position is okay, means doing okay. Now the market has come down a bit after we took the position. It has come down, but we are safe till 15,500 on the lower side, 15,700 on the higher side. So we have a very small call condor with the 200 point sell strikes and 100 point hedges. So if the market continues to move up, probably like today or tomorrow, if the market continues to move up, we will be moving the bull call spread again closer to the spot, probably like 15,500 600 or 15,600 700. When we move to 15,600 and 700, the bull call spread, this will become a call butterfly. So that is where we will end our adjustments, and if there are losses there, we simply book out the losses and come. But when we book the losses, you have to consider what we have booked the profit earlier, means the loss will be less. Okay, this is how the adjustments are made. So thank you very much for watching, and let us see means whether we will continue to hold this position by doing adjustments, or if the market shoots up like anything, we might take an early exit. If you see, the paper loss is about 18,800, but now we will not be losing 18,800 because we have already captured few points here. So this is good for us. So now even we lose, we will be losing about 13k. Even this position goes into means completely ITM or completely OTM, we will be losing a max of how much? A max of about 13k. So our maximum profit is 11k. So now it will not be 11k because we lost few points here. So it will not be 11k. It will be lesser, but the proportionately the risk reward ratio will be about a slightly higher. So we are okay with it. Let's see means how the position goes, and I'll update you if there are any more adjustments we are doing. Thank you very much for watching.
Hello guys, today we have come to the second adjustment session. So right now the market is at 15,500. So we are going to do the adjustment on the bear call spread. So we have got 15,700 and 15,800. So we will be moving these strikes to 15,600 and 15,700. So for that, what we are going to do, we are going to book the profit and then collect additional credit on the bear call spread. Whenever we are doing adjustment on a bear call spread like rolling down, so we will be getting additional credit. Okay, let's do. Here what we can do, you can save brokerage by basically buying 15,700 600 quantity, so that the 300 minus 300 would get cancelled and then we will get 300 positive. So this one we will close, and 15,600 we will go and sell separately. So what we do basically, like we close this position, first one. If we close this one, then we will have a issue of margin shortfall, because this will be a naked sell, so the margin requirement will shoot up, we might get a peak margin penalty. So for that, first what we need to do, we need to exit this one with 600 quantity. So we will go with the market price, that's okay, because this is a far OTM option, so this is okay. So the margin required is 5,000 rupees only. Okay, so we will buy. So this is already purchased. Now we can go and exit this market order only. So we exit this. So now we have to go and sell 15,600. So let's go to 15,600 3rd June CE. So we have it about 23 rupees. We can go and sell 300 quantity. We will sell it for about 23.1 should be okay. 23 should be 23, 25 should be okay. Let's try this. If we are not getting, then yeah, it's going up, so no issue. So we can go, yeah, it's going up, so no issue. 23.5. So yeah, selling regular 300 quantity. Let's see. See, it's going down. It's going down. It's going down further. Let's go and revise. Like 23. No, it's going down further. Let us go to market order. So no issue. Means we are anyway rolling down, so not a problem. So we sold at 22.75. So right now, what are our position? So we have got a 15,600, 15,700 bear call spread. Oh, you see, it has gone to MIS, so we have to change it to NRML. Convert NRML. Yeah, done. So the position is going on. Let it go. Let us see. Means it's in the minor loss, but still it is okay. We have simply moved down a little bit. So now our strikes are 100 points wide sell and 100 point wide hedges. So if the market needs to close between 15,500 and 15,600, then we will be getting good amount of profit. So right now what we have done, we have booked profit in 15,700 800 leg, and we have collected additional credit of 2275. So this one we will update it in the Excel file. Let's see what we have. So we closed this leg. How much did we close? 15,700 at 8 rupees 35 paisa. At 8 rupees 35 paisa, and 15,800 at 375. So now we have already booked 7,548 rupees, and now we have taken a position of, now we have taken, we have taken 15,800 and 15,700. So 15,800, the premium, sorry, 15,600, 15,600. So this is 15,700. So 15,700, we know means what premium we bought. It is 8 rupees 35 paisa. So 8.35, 300, and 15,600 we sold for 22.75. So 22.75. So right now this is the position we have. Let us see means how the market moves, and if the market moves further down, we might revise these 15,300, 15,600 and 15,700 strikes to 15,500 and 15,600. Means then we will get a iron fly. Means that is our end of adjustments. Okay. Let's see means how it pans out, and then I'll let you know if I am making any adjustments. Thank you. Hello guys. Looking to exit the Call Condor at the opening, because today we are going to have a gap up opening at 15,655. So it will be somewhere in the middle of this. So we will be in a good profit in the bull call spread, but we will be making loss in bear call spread. But we have already booked about 7.5k of profit. So I'm looking to lock the profit, maybe a minor loss on the profit, but overall I am planning to close it on the profit. Let's see when the market opens, we will close it. Thank you. Hello guys, so let's close the call condor. We are having about 4-5k of profit and we are making a good amount of loss here. So let us close the positions as a market order because the market is shooting up. Let's see. So all the orders are executed now. So we made a very good loss here, about 90 points, means a huge amount of loss here, but we made a good profit here. Like you can see that here we bought back at 64 and then we sold this at about 1530. So let's see, means where we stand here. Let us go and update our Excel file. So what we did, we closed at 247.46. So what we did is 247.46. We closed somewhere about 3.2k. Let's see what we did here. 15,500 we bought back and we 15,500 we bought a 150.7. 150.7. So here we made about 1700 rupees and this is the one which gave us the trouble. Let us see, means what we did here. 600 we buy back and 700 we sell. So 600, what is the price we bought back? 600 is 64.4. 64.4. Good amount of loss there. And this is 15.3. So 15.3. Here we made a very minor profit. So together we made a loss here. So plus this, so minor, means we closed at about 2100 profit, but still okay. 2100 profit is still okay. We moved few strikes, means we moved the bull bear call spread close to the spot, means now since the market is shooting up, so we were making good amount of loss there, but it was prudent to exit because if it goes much outside the zone we will be making somewhere about 12k of loss, means after removing all the profit we would be making about 12k of loss. But okay, market is cooling off a bit, but still okay. So about 100 200 rupees 300 rupees in profit, but that is okay, means we exited, but at the end what we did, we closed in profit. So right now, means you know that the call condor, how it is made and how the adjustments are made and how we exited. So all those was explained in the series of videos. I hope the video and the live positions and adjustments and updates were useful to you. Thank you very much. Take care. Bye bye.
Hello guys, welcome to the closing session of the call counter strategy for the weekly expiry 3rd June 2021. So now our positions are all closed, so we do not have any position left. We have done the call condor strategy and the adjustments of call condor when the higher upper strike is breached and then the lower strike is breached, then the market got settled somewhere at 15,690, which is almost close to the upper strike of the upper sell strike, means you can say. But we did lot of adjustments here and this is going to be a good learning session for the beginners, and whatever I am going to discuss on the adjustments is going to be a bit heavy. So and I will go through there is another adjustment strategy to extend the range. I'll go through that. So it is going to be heavy. Okay, I'm not lying, it is going to be heavy. So please concentrate on this so that you will learn the strategy as well as the adjustment properly. I'll focus mainly on the adjustment because strategy I have already done the video. You can have a look at it. So the adjustments and closing is what we are going to discuss. The adjustments you have already seen in the previous session, means I have two adjustment sessions. One is moving down the bear call spread. The other one is moving up the bull call spread. The first one we moved the bull call spread because our upper sell strike got breached, means which is our upper sell was initially, what was our upper sell? Our upper sell was 15,700. So the 15,700 strike, briefly it got breached. So what we did, we moved the bull call spread from 15,200, 300. We moved 200 points above. What we did, 15,400 and 500. Here you can see we have done a roll up. So profit booked on 15,200, 300 bull call spread because the market has moved 200 points from the level of entry. What was our level of entry? It was 15,430. You can see at the row number 18 at the spot. You can see when we entered it was 15,430. The market had moved more than 200 points and it was almost near our upper sell strike. So as a standard adjustment, what we had to do, we had to move the bull call spread, means to move equivalent to the movement from the entry of the level of entry. From there we have moved 200 points. So we moved 200 points our bull call spread. So hence we moved the bull call spread 200 points close to the spot. When we did this one, the spot was somewhere around 15,670, means it has moved quite a lot, means about 240 points it had moved. So we had to move about 200 points. Then we came to next adjustment. So when we did this adjustment, let us see what was our initial position and how we moved. So we will just do the first movement. The first movement we will go through in the Obstra. I have already got our initial position there. If we had not done any adjustments, we would have got 11,376 rupees profit. That is what it is showing. You can see we are almost at the upper sell strike. Means when you see the rear view mirror, it is what we call it as a hindsight. So it will be 20/20, 100% it will be clear. Your eyesight is crystal clear. But when we took the position, we don't know what is going to happen. Today we all know that the market closed somewhere near 15,700. But when we took the position, it was 15,400. In 1 week, the market has gone down and then it has gone up and again it has gone down and it has gone up. So it was a very volatile market. Even the VIX was very low, but it was very volatile. If we had not touched this call condor, we would have got 11,376 rupees. We ended up with somewhere around 3,200, 300 rupees. That's all we had not got much. Actually, we got about 2,000 rupees only because I took some expiry trades. The profit has gone up. I'll explain that in a short while. I'm not boosting up the profit. We closed it at about 2,100 rupees. We did not get this 11,000. Why? Because we did adjustments based on the market. If we don't adjust and consider the market has shot up to 15,800 or 15,900, we would have lost 18.8k, which is close to 19k. Here, you have to always consider that no profit or less profit is better than losing your maximum loss. Your capital protection is more important than making a super duper profit. Any new trader, you need to understand that. Because for the margin block, the loss is about 9%. 9% of your capital. If you have deployed your entire margin, you consider that you had only 2 lakhs with you. So you did the same thing as what I have done, 4 lots. So 2 lakh capital you have put. What you would have lost? You would have lost close to 20,000 rupees, which is 10% of your capital. Like this, we don't lose. We will try to protect the capital. Even we get lesser profit or no profit or very minor loss for 1 week, it does not matter. Your capital is protected. So you have to emphasize on capital protection than making a super duper profit in any option strategy. The first and foremost goal or aim is to protect your capital. The profit will come, but when you start doing, the profit will come, but the first and foremost is protect your capital. Okay, so what we did that we closed these two. When the market moved closer to 15,700, we closed the bull call spread, and then we moved this bull call spread 200 point closer. Let us update this. So what we did, let us edit this one. So this one we did a exit, and at what price we did exit? 416.99. Okay, so we did a exit at 416.99. So we modify this. Yeah, the trade you can see in Opstra, the trade will get closed. The chart will change, but does not matter. At the end, again, we will come back to the same call condor. Okay, so then 15,300 we closed. We closed at what price? 324.35. Okay, so we closed at 324.35. So we modify this. So this bull call spread was closed. So now it's only a bear call spread. You can see when the bear call spread, if the market goes up, we lose. The market comes down, we will get a profit. Okay, this is a bear. But what we did, we put another bull call spread. Let us add that bull call spread. So what we did 15,400 and 500. 15,400 to 36.634 lots. Okay, 15,400. 15,400 is 236.63. So this one 15,400 is a 15,400 is a buy. Okay, buy. So the option price was 236.63. We just add the position here, and we sold 15,500. 4 lots for what price? We sold it for 156.48. So 156.48. So now we will come back to the call condor again, but with the reduced range. If you can see, the range is reduced. Here, if you see, the maximum loss was 18K before, but now since you booked the profit, your maximum loss has reduced by around 3.5 to 4K. It has reduced, and your maximum profit also increased. Initially your maximum profit was how much? 11K. So now your maximum profit also got increased to 14K. This is what the adjustment will do when you book the profit. Whenever you are coming close to the spot, your sell strikes are coming close to the spot, you will be booking profit and then paying for less points to get the difference. The difference will be more. When you take the position, when you are coming close to the spot, for the 100 stake difference, initially we paid 80 points. Second time we would have paid about 75 points to 80 points, means somewhere around that. 75 points plus we would have paid, means that 5 points, the 25 points is again. Initially we booked some profit, then again we go and take a debit spread, that difference also we will get. So the profit will definitely go up. Since we are booking profit, the maximum loss will come down. Okay. Now you see, once you do the adjustment, you can see your risk reward ratio is close to 1:1, and your range is still there, 15,450 to 15,750. The range is quite there, but it did not even touch this range. If we would not have done any adjustments here, we would have got close to 15K. Okay. Then what happened? Then what we did, so we moved the bear call spread because the market went down. After we shifted our bull call spread, the market one day it went down, it went and breached 15,500 because 15,500 was our new strike, new sell strike. So it went and breached 15,500. So naturally, what adjustment we will do? Whenever any one side is getting troubled, we are not going to touch that side. We are going to move the other side closer to the spot by booking profit, because one side is trouble means the other side will be in profit always, unless until the VIX goes up very high, the other side will be in profit. So now the VIX is a low VIX environment, so we would have booked profit in 15,700, 800. You can see we booked a very handsome profit. How much we booked? We booked about 2,500 rupees. That I have already shared it in our Telegram group. Let us update this and update this also. Then you will know that how the adjustment is made. So we closed 15700 at 8.35, 15800 at 3.75. Let's do that in Obstra. So we have 15700 and 800 open. Let us close this position. So here this will be, what is the premium? 8.35 and 3.75. So this will be 8.35. So we close this position, and we closed this position also at 3.75. So we close this position at 3.75. So let us modify this. So now what is left out is only the bull call. So you can see the bull call will be very clear. The bull call is when the market goes down, we will make loss. Bull call means it's a bullish view. So when the market goes up, we will make a very handsome profit there. The profit is what? Is the difference between the strike minus premium paid. Difference between the strike is 100 and whatever premium paid is there. So that will be there. So here the break even will be, only one break even will be there because it is a single split. So after doing that, what we did, we moved down. So where we moved down? We moved down to 15600 and 15700. Means we have booked profit in the bear call spread and collecting additional credit by making a new bear call spread close to the spot. Whenever you are making it close to the spot, you will get very handsome premiums. So again, like here we had 24.3 and 11.3. Here almost similar, 22.75 and 8.35. Almost similar means we are getting. So what we can do, almost like 14 points we got here. 14 point, getting a 14 point in a bear call spread just a couple of days before expiry is quite good. Okay. So let us update 15600 and 15700. 15600 is 22.75. So let's add those. So 15600 CE is a sell. So the premium what we sold was 22.75. We'll add this position. And 15700 we bought it for 8.35. Add it. Now we will go back to the Call Condor. It will look like a Call Condor again, but with a very, very narrow range, because right now the strikes what we have open, 400, 500, 600, 700 means completely a 100-point wide Call Condor. Here, if we would have left this position as it is for expiry, we would have got a super duper loss. After booking all the profits, we would have lost about 9,000. We did not lose this, we would have lost 9,000. Okay. So the max profit, if it expires between 15,500 and 15,600, the maximum profit was 70k. Because whenever you do the adjustments, we will always increase our maximum profit and we will reduce our maximum loss. Here you see what is the loss? From 14,000 it has reduced to 12,000. So the loss will come down, and since we are moving very close to the spot, our risk reward ratio is now more than 1. Like this is the big difference between Iron Condor and Call Condor. Many people were asking queries that, sir, what is the difference between a regular IC and Call Condor? Why we cannot take a credit spread? Why we are doing a debit strategy? See, the adjustments will tell you how your RR is improving and how your maximum profit is improving and maximum loss is reducing when you are doing the adjustment. In Iron Condor, you will never get 1:1.46. Forget about 1:1. You will get less than 1:0.5 in Iron Condor. Whatever adjustment you make, this is what you will get. But in Call Condor, your risk reward ratio is much higher when you are moving closer to the spot. Okay, so this was our final position before we closed the trade on the expiry day morning. Just on the tick of the market open, I placed the market order and closed because the market was gapping up. The market, when it opened at 15,670. It opened. It stayed there throughout the day and then it closed little higher. So it's about 110 points, 120 points higher. But it was well above our upper sell strike, because at this stage what we could have done is we could have moved this bull call spread closer to the spot, means like making it as a iron call fly, sorry, not iron fly, it is a call butterfly. When you make a call butterfly, you will have two cells at 15,600, one buy at 15,500 and one buy at 15,700. So when the spot expires at 15,600, you will get a super duper profit. Okay. But what I did, I do not want to do that adjustment because I knew that the market will shoot up like anything and I don't want to take. So what if I wanted to extend the range of the call condor further? You have to be attentive because this adjustment is something which I have not done and which I have not explained in my regular call condor strategy session, because we keep on moving the bull call, we keep on moving the bear call. Whenever the market moves, you have to basically move on the other direction. That I have explained up to the call butterfly. After the call, or if you don't want to come to the call butterfly, there is one more adjustment where you can increase your range. How you can increase your range? You have to do, because you know the market is going up. So what you can do is, these are all NRML orders. You can go and do a MIS order at 15,650 by 15,700, double the quantity sell, and 15,750 buy. If you do that, your range get extended by about 60 to 70 points. Yesterday I have done, but now the market is closed. I don't know what premiums I had put. I forgot those premiums. But it will, let me tell you, I had the premiums. Let me tell you. It would have looked like this. The position means what I have done, I have added 4 lots, means we are doing 4 lots. So I would have done 4 lots of 15,650. This is a MIS order. 15,650 at 19.3. This is a buy. Then we go and sell double the quantity, 8 lots of 15,700 at 8.2, means you will be collecting about 16.4 here, and you will be paying a very little premium because far out of the money, 15,750, you will be going and buying the equal quantity of what you bought on the lower side. So if you do this, then what you will get is basically a call condor like this with a small wedge you will get. So here, if you see, initially our range was, what was our range? Initially our range, our break even was 15,659. This was our break even range. Right now, what is going to be our range is 15,703. Means this is what we will get, and here again the risk reward ratio is much better. So the break evens after doing the new call butterfly, out of the money call butterfly, closer to the upper strike, you basically extend the upper break even by about 50 points. That is what this has done, 50 points. Here you will need to have some margin money available. Initial, the margin money was about 2 lakhs. So you will need additional 2 lakhs to take the position, close to additional 2 lakhs. The MIS, you will get some benefit because nowadays MIS, as per the SEBI rule, you cannot get much benefit. So you consider that you will need about another 1.5 lakhs means to do the adjustment. So this is quite heavy. This money is quite heavy. I could have done that, but I had the money. I could have done that, but I did not do. I simply closed the position and come out because I know but that if I leave the position open, probably means I will close the trade in loss. I had already booked a 7.5k profit and I booked about 5k loss today. So if you see the difference, it's about 2.1k. That is the profit at the end I got. Okay, so the range, the point is the range when you do the call butterfly, out of the money call butterfly, at the upper side you basically extend the upper break even range. Here from 15,659 it has come to 15,703. Somewhere about 45 to 50 point the range gets increased. Okay, that's the point. So this was the position we had. So what we did was, on the tick of the market open, I went and placed the market order, which I have already explained in the previous section. You could have seen how we closed it. So I just went for the market order and just booked out and came back. So no tension there. Okay. So what I did, I went and closed all the orders here. So what you can see, closing the entire trade as the market gapped up, breaching upper strike of 15600 and closed at 15665 because the market opened at 650 plus, then it already breached our upper sell strike. So the possibility of adjustment is to move up the bull call spread and make it as a call butterfly at 15, 500, 600, 700. We could have done that. Or we could have done a call butterfly, out of the money call butterfly, and extended the range to 15703. Even I extended the range to 15703. The profit what I would have got is the small one. What is here? This is somewhere around 1000 rupees. Means that is the profit we could have got here. And if the market would have further gone down, we would have lost somewhere about 14k. Okay, this is what we don't want to lose. If I would have left the trade today, where we closed somewhere here today. 15,700 plus somewhere 1000 rupees we would have got, but we don't know. Now we are saying okay, we could have got profit, we would not have done any adjustment, we would have got 11k profit, or one adjustment is enough, we would have got 14k profit. All these are okay. These are all we are talking after everything is done. But when the market is moving and it is going to breach your position, that emotions you cannot control. Means this is the what we call in English bun and butter of option seller. Adjustment is the bun and butter of option seller. We are Indian option sellers and I am a South Indian option seller. So it is a idli and sambar of a option seller. If you are North Indian, it is a pav and bhaji for a option seller. And since I am a Kannadiga, so this is a kara bath and kesari bath of a option seller. Okay, adjustments is the bun and butter. So if we don't do adjustment, you would have done money, got a lot of money, but that's okay. Means I am not sorry for that because this is the essence of making any strategy and doing adjustments. Okay. So how we closed? Means we closed at, don't worry about this because I had taken couple of expiry trades. So this has expired worthless. So this I just got another 1.5k. So that 1.5k is my profit, means which I got. But actual profit what we received was after, if you don't take care of these adjustments, let me just remove this. This is 31. Let us do only this. So we made a loss of 5,400 rupees only today on the adjustments because we had booked a good amount of profit. So at the end we booked 7,500 rupees profit and we made a loss of 5,400 when we were closing the position. So altogether we made a profit of 2,100 rupees. That's okay. Means after if you take out the brokerage and charges, we made 2,000, little less than 2,000, but that's okay. But the thing is, we did not lose 14,000 or 18,000. We made some profit, right? We did not lose 14,000. That is what is important. We made a few profit, but even if I would have closed it at break even at zero profit, I am happy because I have not made a loss. Or if I would have made a minor loss, it's okay. But I have protected my capital. That is what is important. So I hope this strategy session was helpful to you, and I hope you have learned something from this, and I hope now there won't be any more questions about the difference between a call condor and a iron condor. You can see how different is call condor from iron condor. The payoff looks same, but when you start doing the adjustments, you see the risk reward ratio, you see the break evens, you see how the maximum loss is reducing and how the maximum profit is increasing. Okay, when you do adjustments in iron condor, same thing will happen, but not in this scale. When you do that, always the risk reward ratio on the iron condor. If you come to iron fly, yes, risk reward will be quite high. But when we are doing only iron condor, like you have some difference between the sell strikes, then always the risk reward will be less than 1 in iron condor. You can do any combination with the actual prices you can put in Opstra and you can check. It is not going to be 1:1. But in call condor, you will always get when you do the adjustment, you can always, when you come very close to the spot, you will get a very good risk reward ratio. Your pop will be very less. You can see the pop not applicable, it says the pop will be very less because you are too close to the spot. If it is the expiry is already done, that is why it may not be showing, but your pop will be very less, maybe like 10%, but your risk reward ratio is more than 1:1. In this case, it is close to 1:1.5. Means you are risking 1 rupee, you will get 1.5 rupees. So you are basically like you are trying 1.5 times of your money. It will become not double, it will become 1.5 times. If you have like 1000 rupees, you will get 1500 rupees, like that. You are risking 1000 rupees to make 1500 rupees, as simple as that. So I hope this session of the closing out is helpful. Let me summarize. We have opened a call condor for June 3rd 2021 expiry. When the market initially, the market went up, it had breached the 15700 strike, the upper sell strike. So we did the adjustment of moving the bull call spread closer to the spot by 200 points. Then the very next day, the market went down and it breached our lower sell strike. What is our new lower sell strike? Is 15500. It went and breached 15500. So what we did, we moved the bear call spread closer to the spot by about 200 points again. Means we went and moved the the bear call spread by 200 points with 15600 and 700. Means we went and closed this one. So the new call condor is like this: 15400, 500, 600, 700. This was the new call condor. And we went and closed, since the market was gapping up very high on the expiry day. It is going to be difficult. Whenever on the expiry day, any positional strategy, if you are at the upper or lower strike, the adjustments are going to be troublesome. Here what we did, we don't want to lose the profit what we had booked earlier, because till yesterday the profit was 7548 rupees. So we knew that today morning the SGX was showing 15750. So we knew that the market is going to go up today, it is going to gap up. So what I did on the tick 9:15 when the market opened, I went and placed a market order to close all the positions together. So all the positions got closed, and when the positions got closed, as for like this, it shows like credit, but it's not credit. There is, I think, some issue is there. Okay, you have to see the difference between this. When you see everything, means we lost about 5427 rupees while closing the call condor. Means after doing all this adjustment, we did all these adjustments and then we lost 5427. But actually we had booked a profit of 7500 rupees earlier. So the difference is 2121 rupees. This is what we got. This is excluding the brokerage and charges. We are just tracking only the option closing price. Means we have taken so many trades. So those trades we would have incurred. For every order you consider like 20 rupees. So we did 4 orders. So this 80 rupees. And here 1, 2, 3, 4 together, 5, 6, 7. So 7. So total 11 orders. So 11 into 20, 220 rupees we lost here. So that's what I said. 1900 rupees minus a few charges will be there, because ITM was not square off, right? We closed the position. So there will not be much STT, and the price was also less. It's not like 500, 600 rupees. It's only 200 rupees. So STT, the other charges will be less. So you can consider that safely 1900 rupees we made profit, which is about 10-15% of our max profit, but that's okay. We did not lose money in this trade. We have made a minor profit here. Let us see next week. I will not be talking as much as detail as what currently I am doing in the next week, because by now, after you go through this video multiple times, by now you should know that how we do the call condor and how we make the adjustments. So next week I will be simply putting the levels up in the group, as well as, if possible, let me put a YouTube video of the setup, and then we will follow if there are any adjustments. and we'll follow with the closing also. I may not be discussing the nuts and bolts of the strategy again because we have already done enough of it. If any doubt is there, you can always ping me in the group, and I'll be happy to help you. So thank you very much for being with me throughout this week on the opening, adjustment and closing of the Call Condor. Have a best day. May the markets be with you. Thank you.
Thank you for watching. Please post any questions you have in the comment section. Also, do not forget to like and share the video and subscribe to the channel. To find us on Twitter, Telegram, and Facebook, use the username NiftyBN. Also, we post some of our trades to the community tab, so do not forget to check that from time to time.